The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. This is Brian Van Drill with Premier Life and Annuities, the National Marketing Director, and want to thank you first and foremost for taking your time to be with us today. We're going to be covering qualified plans inside life insurance, and I want to introduce one of our speakers today, Mr. Mike Zemuretti. Mike, thank you for being with us today, and I'll let you take it away.
Thank you so much, Brian. We're very excited to be here on behalf of the National Life Group. It's an interesting time of year. We have positioned this WebEx for you because taxation is on everybody's mind. April the 15th came and went. Some people got good news, some people got bad news, and some people are trying to figure out what it was, whether it was good or bad. So having said that, we have an exciting value proposition for you today that you can capitalize. The National Life Group is 166 years young. We're really known as a career company for much of that 166 years. And the reason I mention that to you, in 1996, with the acquisition of the Life Insurance Company of the Southwest, we really put on a platform for independent agents such as yourself to tap into all the resources that our company has put together, and one of those resources is going to be speaking with you today. Ina is not 166 years old, but she has a lot of great experience with our company, as does everyone. And in setting the table before I introduce her, we have some interesting announcements coming out. In May, we have a new illustration software program that is web-based. We have a new enhancement to our lifetime income benefit rider. We were one of the first carriers in the IUL space to put a guaranteed for life income rider on their product, which is similar to the Paycheck for Life theme you saw on annuity products with income rider. As a result of our robust living benefit story, coupling terminal, chronic, and critical illness for free at no extra charge or no extra underwriting on all of our life products, as a matter of fact, and that lifetime income benefit rider. Last year, we were the #3 IUL carrier in market share in the country. But I firmly believe that what you're about to see today, and if you follow us with future WebExes, we are really #1 in terms of value proposition. So it's my pleasure to announce Ina Anthony, who is involved in our qualified plan sales area and qualified plans desk. We have a regular sales desk, an advanced sales desk team, and we have a special qualified plans team. So I would like to introduce Ina Anthony. She's at home office in Montpelier, Vermont. Ina, thank you for joining us this morning, and please take it away.
Thank you, Mike. Good morning, everyone. Very nice to be here. As Mike said, I am in the advanced sales area, and part of that area is qualified plan marketing. And in qualified plan marketing, there's myself, Sarah Gagne, and Kathy Robinson, and between us, the three of us, we have over 100 years of combined experience. So as Mike said, I'm not 166 years old. Some days I feel it, but I'm not. But between the three of us, we have a great deal of experience in working with qualified plans. So our goal is to work with you and your business owner clients to come up with the best plan design possible to meet that business owner's goals and objectives. So to that end, we do customized retirement plan designs. There is never a one-size-fits-all plan. The plans are unique to the goals of that business owner. We design new plans, but we also review existing plans. And actually, when you're talking to a business owner that currently has a plan, it's actually an easier conversation to have because clearly that owner knows the value of having a qualified plan, but maybe the plan they have today isn't the best plan for them because people come and go in a business, the demographics change, and a plan is very much dependent on, the way it functions is dependent on the ages and salaries of both owners and the rank and file employees. So it never hurts to suggest a review of the existing plan to see if it still meets those goals and objectives of the business owner. Maybe there's another type of plan that could work better for them. So we're always happy to look at an existing plan and make suggestions. And if it is still the most appropriate plan, that's okay too, because at least you can ease that business owner's mind that they're doing the right things for retirement, and maybe they're more open to talk with you then about other things that might be keeping them up at night. We'll do telephone consultations. So when we do case designs and send them out to you, you're not left alone out there in the wilderness. We fully expect you to pick up that phone and give us a call and go over the designs with you. We'll tell you why we did what we did, the thought process behind it, so that you can prepare for your meeting with that business owner to present that design or designs. There might be a couple of options that would be suitable. We do webinars and teleconferences as well as agency visits. We'll do seminars specifically for CPAs and attorneys. Sometimes agents want to set up continuing ed sessions for CPAs, and it's a great way to get in front of those CPAs and potentially get them for clients in the future. And so we're available to do seminars to help with them get continuing ed credits. And of course, we have various sales ideas, promotions, and prospecting tools. And all of our materials are available on the National Life website under NL Group U, not just for qualified plans, but for all types of plans for business owners. So we can also, in all of our plans, we're going to include life insurance. If life insurance can be added, we're going to show that as part of the contribution. So we have a number of life and annuity products that can be used in qualified plans. And some of the other things that we do is we can talk about issues that might come up with someone maybe inheriting an IRA and what to do with that. What are their options? What are the taxation on the benefits inside the qualified plan, including the life insurance? We can also run 72T and 72Q quotes for someone who's under age 60 and wants to avoid the 10% early distribution penalty tax. We do minimum distribution planning, which includes illustrating stretch IRAs and the multi-generational planning that comes along with a stretch IRA. So those are things that we do over and above the qualified plan designs. And all of our services are free. We don't charge for plan designs. We'll do as many designs as is needed to get the right design for that business owner client, but you don't pay us anything to do that. Basically, we get paid if you sell our products, and that's what we want to do, is position our products in qualified plans and make them attractive to those business owners. So we do all qualified plan types. And I'm going to talk very briefly today about the defined contribution plans and the defined benefit plans. I also have simple and SEP IRAs listed here, and we will design simple and SEP IRAs for business owners, and sometimes that is one of those would be the best option for that business. But SEPs and simples can't have life insurance in them because they are IRA plans, and the IRS doesn't allow life insurance in IRAs. So depending again on the goals and objectives of the business owner, we might suggest that the simple or SEP IRA is the most appropriate plan. But in most cases, we're going to design either something in the defined contribution or the defined benefit arena. And as I said, one size does not fit all. As you can see from this menu, there's a lot of different plan options, and it's going to depend on the demographics of the business and the goals of the business owner as to what type of plan makes the most sense. So as I said, life insurance can be included in all qualified plans except SEPs and simple IRAs. The IRS says they will allow life insurance inside of a qualified plan as long as it's incidental to the reason for having the plan, which is to save money for retirement. So for that reason, they do have limits on how much life insurance can be included in the plan, and I will discuss that in the next slide. But why would a business owner want to include life insurance in a qualified plan? Well, first of all, any contribution that's going to be made to the plan is going to be tax deductible. So by paying for the life insurance premiums in the plan, those premiums are being paid on a pre-tax basis, and the business is getting a tax deduction for it. So it's freeing up that person from paying the life insurance premiums out of pocket on an after-tax basis. And life insurance really completes the plan. Should that participant die while they're still in the plan, their beneficiary is going to receive the death benefit of the life insurance in addition to the values that have accumulated in the side fund account of the plan. If that person died without life insurance, the beneficiary is only going to get the value in that side fund account. So if someone is planning for retirement and they have a significant other in their life, they're planning that retirement with that individual. Should they die prematurely, then that also puts on hold the plans of that surviving person to look to the future and retirement, because they don't have that money that they were counting on in retirement. Keep in mind that because life insurance is paid with pre-tax dollars, there is some taxation. The taxation is not, and I repeat, is not on the death benefit. It is on the cash value accumulation. And if the individual is still living at retirement, there are ways they can remove that policy from the plan and use that policy in retirement. They can access those cash values for retirement income. They can use the ABR riders, the lifetime income benefit rider, because once that policy is removed from the plan, it belongs to that person individually. While it is in the plan, it is owned by the plan trust. But when it is removed from the plan, it does become a personally owned policy. So here are the incidental benefits for life insurance if the plan is a profit-sharing plan. The IRS says if the plan is going to include whole life insurance, up to 49.9% of the annual contribution can be used for the life insurance premium. And if the policy is UL or IUL, up to 25% can be used for the life insurance premium. So in these examples, I'm using $52,000 as the total profit-sharing contribution. That is the most any one individual could get as a contribution this year. So if that person were to use whole life insurance funding at the maximum amount they could get in the plan, that would mean a life insurance premium of $25,948. Now the death benefit will depend on the person's age and underwriting class. It will have to go through underwriting. So we don't know what kind of death benefit this person could get, but we know how much life insurance premium they can use. Now, as I said, this is paid on a pre-tax basis. If this person were in a personal 33% tax bracket and he were to buy that same life insurance policy outside the plan, he would have to gross $38,728 to net that same $25,900 premium. So having it inside the plan is freeing up those personal dollars. He doesn't have to dip into his own pocket to pay that $25,900 premium. And if they decided to use UL or IUL in the plan, then we know that up to $13,000 of that $52,000 contribution could be used for the life insurance premium. And again, paying on a pre-tax basis is saving him in taxes because he'd have to gross $19,400 on an after-tax basis to net that same $13,000 premium. So that's the efficiency of paying for the life insurance inside of the qualified plan. Now, profit-sharing plans also have some additional rules for purchasing life insurance. These are known as the season money rules. And basically what the IRS says is that someone who has been a participant in the plan for at least 2 years can use up to 100% of the money in their account, including forfeitures, to fund the life insurance policy under the plan. So those incidental limits go away with season money. The person isn't held to 25% or 49.9%. If they're using seasoned money, they could use up to 100% of that money to fund life insurance inside the profit-sharing plan. And the other seasoned money rule is called the 5-year rule, which is anybody who has been an active participant in the plan for at least 5 years can direct up to 100% of their account, both old and new money, to purchase life insurance. So those rules can come into play if you have a business owner who has a profit-sharing plan today but doesn't have life insurance in the plan. They could amend the plan to include life insurance, and they could use the season money to pay those premiums under the plan. And there is another way to purchase life insurance in a profit-sharing plan. It's with rollover money. So if someone has qualified money sitting somewhere else and they roll that money into the profit-sharing plan, they can use that money to purchase life insurance under the plan. That's not the 2-year rule or the 5-year rule. That's an additional rule for using qualified monies to purchase life insurance. So you might encounter someone who used to work for a business and had a qualified plan with that business, and they left, and they rolled their qualified money to an IRA. And now they've set up their own business. Maybe they've become a consultant. That person could establish a profit-sharing plan for their new business, and they could roll that money into the plan and use it to buy life insurance in the plan. Or maybe you'll encounter someone who set up a SEP IRA for 2013, and now they want to establish a profit-sharing plan for 2014. They could roll that contribution they made to their SEP IRA into the profit-sharing plan and use it to buy life insurance under the plan. So there are a number of ways that life insurance can be purchased under a profit-sharing plan. And these rules are very specific to profit sharing, not defined benefit. And when I say profit sharing, I'm also including in there 401k. So life insurance does complete the funding, and this is what I said earlier. The beneficiary would obviously get the death benefit of the life insurance along with whatever was in that side fund account. That's what we call the other aspect of a qualified plan. There's the premium for the life insurance, and then there's the side fund account where the balance of the contribution goes. The side fund can be invested in really anything. It could be stocks, bonds, mutual funds, annuities, basically whatever you're recommending to that business owner. And there are different types of profit-sharing plans. So again, depending on the age demographic of the business, that's going to determine the best type of profit-sharing plan. If it's a situation where the owner and the employees are all around the same age, but the owner takes a much higher salary, really the only option is to integrate the plan with Social Security. So people earning over the Social Security wage base are going to receive a slightly higher percentage of salary as a contribution than those who earn under the Social Security wage base. But if you have a situation where you have an older owner and younger employees, then some type of age-weighted plan is going to favor that owner. Now, there's the standard age-weighted, but the one that we design the most is called a cross-tested profit-sharing plan. And under cross-tested, the owner gets to group employees in different groupings, the goal being to try to minimize what has to go to the employees and maximize what the owner receives. It's also a good way for an owner to favor somebody. They might put one employee in a different grouping from everybody else and give that employee a slightly higher percentage of contribution over the remaining employees. So, but in those cases, it has to be an owner who is at least 5 to 10 years older than the average age of the employees. That's what's going to make that plan make the most sense. The traditional plain vanilla profit sharing plan is where everybody gets the same percentage of salary, and the difference between using that and using, say, a SEP IRA is that the profit sharing plan will allow for life insurance and the business owner can have a vesting schedule on it. With a SEP IRA, they can't have life insurance and everyone's 100% immediately vested, which means as soon as the owner makes the contribution for those employees, the employees can come in and take the money out. Yes, they'd have to pay tax on it, but the owner cannot stop them from taking money out of that account. So even if the plan has to be a traditional plan because you don't have older owners making higher salaries, at least with a vesting schedule, the employer can handcuff the money for a period of time. And then we do 401k designs, and there's different types of 401ks. Traditional 401ks, where the employer may decide to give a match or non-elective contribution or a profit-sharing contribution, but doesn't have to. The employees, anybody can defer 100% of their salary up to $17,500 if they're under the age of 50, or up to $23,000 if they're going to be 50 or older this year. But under this type of plan, the highly compensated employees could be limited in their deferrals because their deferrals are going to be based on the average deferral of the employees. So if the employees only deferred on average 3% of salary, the owners could only defer 5% of their salary. So that might not get them to the $17,500 or $23,000 maximum deferral. So they could be very limited in what they can defer. And that would really be true when you're dealing with a small business owner, someone with very few employees, because the employees might not take advantage of the opportunity to defer money for their own retirement. In that case, we would look at a safe harbor 401k, and we design a lot of safe harbor 401ks. And under a safe harbor plan, it doesn't matter what the employees defer or how much they defer, the owners can always defer the maximum. The trade-off is the employer has to give a matching or non-elective contribution. That is a requirement. They have to do that. And the employees are going to be 100% immediately vested in that match or non-elective because it's something that the employer has to give them. But the employer certainly can take advantage of maximum deferral under a safe harbor where they may not be able to do that with the traditional 401k. And in both plans, the employer can include a discretionary profit-sharing contribution. Now, in theory, the IRS would allow life insurance premiums to be paid out of employee deferrals. However, most TPA firms do not want to do that because administratively it's very difficult for them to track. So in a 401k plan that includes rank and file employees, the only way life insurance could be included is if the employer was making a profit-sharing contribution under that 401k plan, and the life insurance premium would be a percentage of that profit-sharing contribution. So it would not be a percentage of the total amount going in for someone. It couldn't come out of the deferral, and it couldn't come out of an employer match or non-elective contribution. It could only come out of a profit-sharing contribution. Now, it's actually handled differently if you're talking about a solo 401k. Now, you may have heard of them in the industry. They're called Special K, and companies have different names. But basically, it is a 401k plan for a business that has only highly compensated employees eligible to participate. It doesn't have to be one life. It could be a business with a husband and wife. It could be two partners. Usually not more than two people, however. So in a solo K, a match is not allowed, but in addition to the deferral, they could add a profit-sharing contribution. And the benefit in a solo K of adding life insurance is that it is a percentage of the total amount contributed to the plan, both deferral and profit sharing. And you can do that because TPA firms would not have a problem tracking that when you're dealing with one life or two lives inside of the plan. So in those instances, life insurance is a percentage of the total amount contributed. And because it is a solo K, TPA firms charge much lower administrative fees to administer those plans because they're not having to track the deferrals of a large group of people. It's only one or two lives that they're dealing with. Now here's the benefit of doing a solo K over a SEP IRA, because I do get that question a lot is, well, why wouldn't they do a SEP? Well, the SEP is 25% of salary. That's the maximum plan contribution. In this case, if the employer only paid him or herself $138,000, that means the most they could put into the SEP IRA is $34,500. On the other hand, if the same person did a solo K, they can defer $23,000 because they're over 50, and in addition, they can do 25% as a profit-sharing contribution, and between those two amounts, this person would get the maximum contribution they could get this year, which is $57,500. So the benefit of a solo K is a business owner doesn't have to take as much salary to get a higher contribution. And also, they can have life insurance in the solo K where they couldn't in the SEP IRA. Yes, they will have to pay a third-party administrator to get a 401k document. They wouldn't have to do that with a SEP IRA, but what they would pay a TPA firm is far less than the amount they could contribute to that solo K for the year. So that's why when you're talking to business owners who maybe like an S Corp where they're purposely taking less W-2 income to pay lower FICA tax, a solo K might make a lot more sense than trying to do a SEP IRA because they can contribute more even though they're taking less W-2 income. So when you're talking to business owners or you're looking for business owner prospects, really any profitable business entity can have a defined contribution plan. It doesn't matter how they're set up. If they're an S or a C Corp, the contribution is based on W-2 earnings. If it's a sole proprietor, it would be based on net Schedule C, and if it's a partnership, it would be based on net K-1 partnership income. But as long as they're profitable, they can have a plan. If they're not making a profit, they can't have a plan because they can't make a contribution that's going to make them have a further loss in the business. So you're looking for a profitable business, doesn't matter what entity type they are. It's for owners who are looking for flexible contributions. They don't want to be tied to a contribution every year. They want the flexibility to change those contributions. And if they're looking for a way to allow employees to contribute toward their retirement, then that would be a 401k plan, and they understand the tax-advantaged retirement planning. So the profile for the business itself is having few full-time non-union employees, preferably younger than the owner. Maybe it's a startup business or a young business, so they haven't yet got a stable, steady profit history. They could be concerned about their profits fluctuating from year to year, which is why they don't want to be tied to a fixed contribution plan. So the owner's not ready to commit to having to make the same contribution every year. And it's a great way for them to attract and maintain employees who are key to the business. So profit sharing and 401k plans, flexible contributions, great for startup businesses or businesses that do not have a stable, steady profit history. But what if the owner wants more than $52,000 as a contribution? That's when they're really making a commitment to fund the plan into the future, and that's when we're talking about some type of defined benefit plan. And just like profit sharing plans, there's different types of defined benefit plans. A traditional, well really any defined benefit plan is best suited for business owners who are older with younger rank and file employees, owners who are within 5 to 10 years to retirement themselves, who are willing to commit to a fixed contribution for a minimum of 5 to 10 years. Their business has a very strong, stable profit history. And knowing those things, if they're willing to commit to that fixed contribution, defined benefit plans are going to get them much higher contributions than they could get in any type of defined contribution plan. And there are different types of defined benefit plans. The ones that fall under what we call traditional defined benefit include your actuarial funded, what we call DB Select, where the employer is allowed to group employees in different groupings, trying to lower the contribution to at least some of those employees, as well as cash balance plans. In all of these plans, it does require an enrolled actuary of the TPA firm to review the plan each year, and the business owner gets to select the investments. The investments are anything the business owner wants: stocks, bonds, mutual funds, annuities. Life insurance can be whole life, IUL, or UL. The business owner is in charge of those investments. But because of that, there could be wide fluctuations in the contribution from year to year because it totally depends on how those investments perform. This plan is funding for a defined monthly benefit in retirement, and the contribution is whatever is going to be needed to get that benefit in retirement. So if the investments perform very well, the contributions could be substantially lower in the next year, and if the investments perform very poorly, the contributions could be much higher in the next year. And that is what the enrolled actuary is reviewing each year, is investment performance, and then calculating what the next year's contribution needs to be. On the other hand, there is a plan called a 412E3. This plan will generate the highest contribution and tax deduction of any type of qualified plan. And the reason is it has to be funded with life insurance company products that have guarantees, and the contributions are funded at the guarantees of those products. So in this case, the funding vehicles are either 100% to an annuity, or a combination of annuity and whole life insurance. And the annuities guarantee, the one that we use, has a 3% guarantee. So if the annuity earned over the guarantee, those excess earnings have to go back into the plan and reduce the employer contribution in the next year. And if there is whole life insurance in the plan and it pays a dividend, which our whole life has paid every year, then that dividend also goes back into the plan to reduce the employer's contribution in the next year. So for that reason, you will not see wide fluctuations in the contributions in this plan from year to year. The business owner has a very good idea of what the contribution is going to be from year to year, and it doesn't require the services of an enrolled actuary. So the admin fees are lower in this type of plan. So this is the plan for a business owner who's looking for highest contribution, highest deduction, and it's best for a business that has no employees, or if there are employees, 5 or fewer, and they're much younger than the business owner, because they're going to be very high contributions, and the contribution for each person is based on that person's age, their salary, and their years to retirement. So the longer someone has to retirement, the lower their contribution, versus the closer they are to retirement, the higher the contribution. Now, there are certain limits that the IRS sets. The limits are not on how much can be contributed. The limits are, number one, how much salary we can use in the plan to determine a contribution. This year, that maximum salary is $260,000. So it doesn't matter if a business owner earned $500,000 or $1 million a year, $260,000 is the most we can use, and we do have to use a 3 high consecutive year salary average. Last year, the maximum salary was $255,000. The year before that, it was $250,000. So again, any business owner that earns over that, their maximum salary average this year is going to be $255,000, and based on their age and how many years to retirement, that's going to determine how much they can contribute to the plan. We're also funding for a maximum benefit in retirement, and that maximum benefit in retirement is $210,000 a year. Now, the IRS does increase that every year. It's been going up in $5,000 increments, and every October is when they come out with their limits for the next year. So we don't know yet if that will go up for 2015, but there's a very good chance it will, because it has been going up every year for the last 10 years. Now, life insurance included in a defined benefit plan is calculated differently than in a profit-sharing plan. We use Revenue Ruling 74-307, also known as the 2/3 method. It's an actuarial formula that's applied behind the scenes. But interestingly enough, once it's applied, if you're using whole life insurance in the plan, you are going to see about a 50-50 split between the life insurance premium and the amount allocated to the side fund account. If you are using UL or IUL, it will end up being approximately 35% to the life insurance premium in those types of plans. Now, the product chosen will affect the plan cost. Again, we have 2 whole life products that can be used, Life Builder and Protector Life. The contributions is fairly close, but you will see a little bit of difference in the face amount. Will be a little bit lower with Protector Life. And again, if it's 412(e)(3), it has to be whole life insurance. Now, keep in mind that the IRS says life insurance in a plan is a protected benefit, and what that means is it has to be offered to all the eligible participants on a uniform and non-discriminatory basis. So in other words, everybody who's eligible has to be offered the life insurance, and everybody has to be offered the same product. So do they have to take the coverage? No, they do not. If a participant does not want the insurance, they can waive the coverage, which means their entire contribution will go to the side fund account. Or they may not want the maximum amount of insurance they could get under the plan, and they decide to cap it. They may say an owner might be able to get $5 million, and they might say, I only really want $2 million. We cap the insurance, and that would lower the amount of premium going to the policy, and that excess contribution goes into the side fund account. It is possible to design these plans to be limited pay policies in the plan, but again, you can't discriminate in favor of the owner. So in any type of traditional defined benefit plan, if you were designing something like a 7-pay policy for the owner, then everybody gets a 7-pay policy. In the 412(e)(3) plan, the exception there is the premium paying period must equal or exceed the years to retirement for everybody in the plan. So if you had a 55-year-old owner to retire at, say, 62, in theory, you could use a 7-pay. But if there was a 45-year-old employee, that employee has 17 years to retirement age 62, so you could not use a 7-pay. The limited pay period would have to be at least 17 years to cover all employees. So the 412(e)(3), it's a little more difficult to do limited pay if there are rank and file employees, especially much younger rank and file employees. So we don't see that happen too much in the 412(e)(3), but we do design limited pay policies for traditional defined benefit plans, not infrequently. I mean, it is a request that we do get fairly regularly. So again, when you're paying life insurance in the plan, it's pre-tax, the business owner is getting a tax deduction, and in a defined benefit plan, the life insurance actually increases the contribution. In a profit sharing plan, the maximum anyone can get this year is $52,000. It's $52,000 whether or not insurance is included. But in a defined benefit plan, the contribution will go up if life insurance is included. So if the goal of that business owner is maximum contribution and maximum deduction, including life insurance is going to get them the highest possible contribution they can get. Here's an example between a traditional and a 412(e)(3). So in the traditional with life insurance, our first owner, owner A, could get a contribution of $203,000. I don't have the ages here, but owner A is 55 and owner B is 50. So there is quite a difference in the contribution amount with that 5-year age difference between owners A and B. And yes, they do have to contribute for their employees. They happen to have 5 employees, and they're going to have to contribute $74,000 for those employees. But the owners are getting over $346,000 of that total contribution, or 82% of the contribution. Owner A is getting $2.2 million of death benefit. This is using whole life insurance. And owner B is getting $1.7 million. But if we look at the 412(e)(3), as I said, this will get them the highest contribution and highest deduction of any plan. Owner A's contribution is now $253,800. So it's gone up over just over $50,000 from what he could have done in a traditional DB plan. His life insurance premium is now $137,000, and his death benefit is $4.8 million. So whether the traditional or the 412(e)(3) makes the most sense depends on why they're doing the plan. What are they trying to get from this plan? Now, because the contributions are higher for the owners, they also have to give more to those employees. In this design, they would have to spend $97,000 on their employees. But again, they're getting over $407,000, or 81% of the contribution. Now, this is something that could be a hard pill to swallow for the business owner. They might say, I already do a lot for my employees. I give them other benefits. They get a very generous pay package, vacation. I don't want to have to do anything else for them. Well, this is a qualified plan. They cannot discriminate in a qualified plan. If the employees are eligible, they have to be considered in the plan for receiving a contribution. So it isn't as easy as saying, I don't want to do anything for my employees. If they're looking for a tax deduction, this is how they're going to get it, but they have to include employees. But one of the things that we always do when we're doing designs is we include our after-tax analysis comparison. And this will show the business owner how much they're saving in taxes versus what they have to give their employees. So if we look at the 412E3 plan, where the total contribution is just over $504,000, if the corporate tax was 34%, then there's a tax savings of $171,500 for doing the plan. Remember, they had to give $97,200 to their employees, but they're saving over $171,000, which means by doing the plan, they're still ahead by $74,238. So sometimes it comes down to asking them, who do you want to give it to, the IRS or your employees? Because if they don't do the plan, they're going to pay the IRS $171,000 in taxes on this $504,000 of profit. But on the other hand, if they do the plan, they're ahead by over $74,000, even though they have to give something to those rank and file employees. Now, those employees come in and work for them every day and help make the business successful. The IRS doesn't. So even though they have to contribute for their employees, if that tax-deferred gain to owners is a plus, it means they're saving more in taxes than what they're having to contribute for those employees. Another thing that we show in our designs is what that life insurance would cost on a pre-tax basis versus an after-tax basis. So we know that owner A could get a face amount of over $4.8 million, and he would be paying $137,200 in premium in the plan to get that $4.8 million. Outside of the plan, if he was in a 33% personal income tax bracket, he would have to gross $204,800 to net that $137,200 in premium. So this is another way to show why having the life insurance in the plan is saving that individual money. And this is just a quick comparison. Traditional DB without insurance, the contribution would have been in total $236,700 with $289,168. With insurance, it's $420,000. So the cost does go up when you're including life insurance. In the 412E3, if it was 100% funded with an annuity, their total contribution would have been $414,200. With life insurance, it goes up to $504,400. And when we do designs, we always show them with and without life insurance so that the owner can see the difference and what the cost will be. We also have DB Select. I'm just going to go talk about this very briefly. This type of plan allows the business owner to group employees in different groupings, the goal being to try and reduce the cost for some of those rank and file employees. It's also a great way to equalize contributions between younger and older owners. In our example, the 55-year-old owner had a much higher contribution than the 50-year-old owner. Well, if they want to equalize their contributions, the DB Select would allow that to happen, but it's the older owner who's going to take the hit for that, because we can max out both of them, and when we max them out, the younger owner is going to be maxed out at a lower amount. So to equalize them, the older owner has to cut back on his contribution. So if the older owner is okay with that, then we can equalize them in this type of plan. And yeah, so the owners can equalize. And the other one is a cash balance plan. And a cash balance is a kind of odd plan. It could work well for a business that has a 401k today, but the owners want to be able to contribute more than what they can do in the 401k. It defines a contribution. So in that way, it's like a defined contribution plan, but the contribution maximums fall under the DB plan rules. So again, the contribution is, it would be much higher than the $52,000 someone could get in a defined contribution plan. It will reduce the amount going to the employees. It will fall, the contribution will fall somewhere between what they could contribute in a traditional VB and what they could get in a 412E3. It will fall somewhere in between those. Basically, what
happens... We're running out of time. I'm sorry to disrupt, but can we kind of, you're doing a great job, and I wanted to give you a breath. There's a lot of information here. Can we kind of just go to the end and kind of tease everybody with there's more to come, and how would they contact you? Maybe you could talk about the QPEP, this site here, and then kind of wrap it up. And then what we'll do, we'll talk to Brian, and we'll set up a drill-down WebEx, or they can work one-on-one with you if you give them your contact number. So why don't you wrap it up for us? Thank you.
Okay, sure, no problem. So when someone wants to leave the plan, if they want to take the life insurance with them, there are 3 ways they can do it. One of them is they could buy it as a plan for its cash value. That could be pretty expensive. They could pull it out of the plan, and they would be taxed on the cash surrender value at the end of that year. Or the third option is a rider that we have on our products, and this is very exclusive to us. This rider we call the Qualified Plan Exchange Privilege Rider. We add it on all life insurance when it's issued inside the plan. If someone were to exercise this rider, the policy that was issued in the plan would be surrendered in the plan, and the cash surrender value would roll to the side fund account, and they would roll that out to an IRA. So they have deferred any immediate taxation. A new policy is issued outside of the plan, and the face amount of that new policy is the net amount at risk of the policy that was in the plan. It is issued at the individual's current age and with no additional underwriting. And it does not have to be the same product that was issued inside of the plan. So most all of our products, both National Life and Life of the Southwest, are available to be utilized under QPEP. So if someone has developed health issues while they've been in the plan, it doesn't matter because they don't go through underwriting again. So they're going to get the rating on the new policy that they got on the policy that was issued inside of the plan. And it's something that we can do as an analysis as to what makes the most sense, what's the best option for them to do when they're ready to leave the plan. And this is our contact information. In Qualified Plan Marketing, you can reach us through our 800 number, fax, or we also have a QPM mailbox. It's qpm@nationallifegroup.com. Our Qualified Plan Fact Finder is available on the National Life website under NL Group U, Strategies for Business Owners. But we'll take the information in any way you can get it. To do designs, we're looking for dates of birth, dates of hire, and salaries, how the business is set up, what type of entity it is. So really, with that information, we can design the plans and get you the best design possible. Questions?
Thank you so much, Ina. We're gonna throw this back to Brian Vandrell, and also I imagine, Brian, a lot of your agents who are attending this WebEx today can contact you and your life team to be able to access information with Ina and her team. But this was a great WebEx. As you can see, it is somewhat detailed, but we're really great. Our hand-holding is none other than any other carrier in the industry, and I got to tell you, that's why I think we are the #1 value proposition in the industry because of professionals like Ina Anthony. So thank you so much, Ina. And Brian, back to you, sir.
All right, thanks, Ina, and thanks, Mike. If anyone has any questions, you can certainly use the Ask a Question feature on the option there with the GoToMeeting. Everybody is on mute, so if you have any questions, type that in here real quick, and we'll try to answer any questions that anyone may have.
One thing while people are thinking about a question, Ina did skip by a slide, but I asked her to. But really quickly, we're one of only 2 carriers in the country that are versed in Section 79, which is a non-qualified plan. And why I bring that up, it has very minimal expense fees associated with it, maybe $300 to $350 a year to do the plan. And it's another way to deduct life insurance premium and pass along benefits to your employees and take a tax deduction and leverage taxation. And only 2 companies specialize in that, but we have a plan that we think is #1 because, or actually the best available due to our living benefit story and our tax-free income for life approach. And I'm bringing this up because what Sarah would have said to you very quickly was, in conjunction with these qualified plans, if there still isn't enough tax deductions there to help an organization, we can layer in a non-qualified Section 79 on top of, and vice versa. If a client says, you know what, I just don't want to go through all of this stuff. I'm looking at it, but I don't feel comfortable with it. Is there something else we can do? We could do a Section 79 plan and accomplish a lot of this stuff with the tax deduction and be able to possibly leave out, some employees, some part-time employees, seasonal and union workers. So there's a lot of things that we can do, but more importantly, we just wanted to overview to you that we have the ability to assist you at the carrier level in Montpelier, Vermont with some exceptional professionals. So, Brian, thank you so much for inviting us today. I don't think we have any questions, but
Nope.
You can always email them to Ina or you, and then you can send them to me.
Yep, and if anybody has questions, our number here at Premier, 800-365-8208. Just ask for a life marketer. Thank you for your time today.
Thanks, Brian. Thanks, Ina. Have a great Easter, everyone.
Bye, everyone.